Picture this. You open a brokerage app for the first time. You're excited. You've saved up some money and you're finally ready to invest. But then you see it. PE ratio, market cap, EPS, dividend yield, bull market, bear market, alpha, beta, VIX. And just like that, the excitement turns into confusion. If that sounds familiar, this video is going to change everything for you. Because today, I'm walking you through every stock market term you'll ever need, explained in plain English, no finance degree required. I've organized everything into 9 clear sections, so you can follow along easily. And by the end, you'll feel genuinely confident the next time you open that app. Quick note before we dive in, this is financial education, not financial advice. Now, let's get into it. Let's start at the very beginning. What even is a stock? A stock represents ownership in a company. When you buy a stock, you're not just buying a piece of paper. You literally own a small piece of that business. There are 2 main types. Common stock is what most investors buy. You get a share of the company's profits and the right to vote on major business decisions. But dividends, which we'll explain in a moment, aren't guaranteed. Preferred stock is different. You typically don't get voting rights, but you're higher in line to receive dividends. And if the company pays out money to shareholders, preferred stockholders get priority. When you own a collection of investments together, that's called a portfolio. It's everything you hold: stocks, funds, bonds, all of it in one place. Some of those investments may pay a dividend. That's when a company shares a portion of its profits directly with shareholders, usually paid out every quarter. Think of it as a small reward just for holding the stock. Not every company is available to invest in, though. A public company has listed its shares on the stock market. Anyone can buy in. A private company keeps its shares held by founders or private investors only. Now that you understand what a stock is, next we're covering where and how they trade. And I'll share one fact about beating the market that most beginners never hear. Now that you know what a stock is, let's talk about where and how they actually trade. To measure how groups of stocks are performing, we use an index. An index is a collection of stocks designed to represent a portion of the market, used as a benchmark to track performance. The S&P 500 tracks 500 of the largest U.S. companies and is the most widely used benchmark. The NASDAQ is known for its heavy concentration of tech stocks, and the Russell 2000 tracks smaller companies. When investors say they want to beat the market, they almost always mean outperforming the S&P 500. Here's something most beginners never hear. Over a 20-year period, more than 90% of actively managed funds failed to beat the S&P 500. Let that sink in. All these stocks trade on a stock exchange, the official marketplace where buyers and sellers come together. The largest in the U.S. is the New York Stock Exchange. To access it, you need a brokerage, a platform or service that connects you to the exchange. Some charge a commission, which is simply a fee for executing your trade. Every stock has its own unique short code called a ticker symbol: AAPL for Apple, TSLA for Tesla. Trading officially happens during market hours, 9:30 a.m. to 4 p.m. Eastern Time. The price at the start of the day is the opening price. At the end of the day, it's the closing price. But trading doesn't fully stop there. Pre-market trading happens before the open, and after-hours trading continues once the market closes. Investors often react to news, like earnings reports, during these sessions. The catch is lower volume and lower liquidity. Volume tells you how many shares are being traded at any given moment. High volume means lots of activity. Low volume means fewer trades. Liquidity tells you how easily you can buy or sell a stock without significantly moving the price. Large companies like Apple or Microsoft are highly liquid. You can move in and out quickly without much price impact. Now you know how the market works. Next, we're going inside the numbers. This is the section where most beginners tap out. Don't. I'll make it simple. This is the section where a lot of beginners check out. Stick with me because this is exactly what separates confident investors from confused ones. Let's start with market capitalization, or market cap. It's the total value of a company's shares on the market. Simple math. Stock price multiplied by the number of shares outstanding. It gives you a quick snapshot of how large a company is. Enterprise value goes deeper. It factors in not just the stock price, but also the company's debt and cash, giving you a fuller picture of what the entire business is actually worth. Revenue is the total money a company earns from sales. Subtract all the expenses, and what remains is net income, the actual profit. On a company's balance sheet, you'll see assets, what the company owns, like cash, equipment, and property, and liabilities, which is what it owes, like loans and debt. Now, here are the key ratios investors use to compare companies. Earnings per share, or EPS, shows how much profit is generated per individual share. For example, if a company earns $100 million and has 50 million shares, the EPS is $2 per share. The price-to-earnings ratio, or PE ratio, compares the stock price to its EPS. It helps you judge whether a stock looks expensive or cheap relative to its profits. The PEG ratio takes it one step further. It adjusts the PE ratio for expected growth. This is especially useful when evaluating fast-growing companies, where a high PE might actually be reasonable. For income-focused investors, dividend yield shows how much you earn in dividends relative to the stock price, a simple way to compare income-producing stocks side by side. Free cash flow is the money a company has left after covering its expenses and investments. It's one of the clearest indicators of financial health because cash doesn't lie. Finally, profitability margins show how efficiently a company converts revenue into profit. Gross margin is what's left after the direct cost of producing a product. Operating margin shows what remains after salaries, rent, and business operating expenses. And net profit margin is the true bottom line, the percentage of revenue that survives after every single cost, including taxes and interest, is paid. Coming up, not all stocks are built the same. Knowing the difference could completely change how you build your portfolio.
Not all stocks are the same. Knowing the different categories helps you build a smarter, more intentional portfolio. A growth stock is a company expected to expand quickly, often reinvesting profits back into the business rather than paying dividends. Think technology companies focused on scale. A value stock is the opposite. It's a company that looks underpriced relative to its fundamentals. Investors buy them believing the market hasn't recognized their true worth yet, and they're waiting for the rest of the world to catch up. Blue chip stocks are the household names, large, well-established companies like Coca-Cola or Johnson & Johnson, known for their stability and reliable track records. Cyclical stocks move with the economy. Airlines and car companies tend to thrive when times are good, but struggle during recessions. Defensive stocks are the steady performers. Companies selling essentials, food, utilities, healthcare, tend to hold their value even when the broader economy is struggling. Stocks are also grouped by company size. Large-cap companies are worth over $10 billion. Mid-cap falls between $2 billion and $10 billion. Small-cap is under $2 billion. And then there are penny stocks, shares trading under $5. Highly speculative, highly risky, but they attract investors chasing fast, large gains. Here's something interesting. You don't have to pick any individual stock at all. Coming up next, I'll show you exactly how.
Here's where it gets interesting, because you don't have to pick individual stocks at all. A mutual fund pools money from many investors to buy a mix of stocks, bonds, or other assets. A professional manager makes the portfolio decisions on your behalf. It's investing with a co-pilot. An ETF, exchange-traded fund, works similarly but trades like a stock on an exchange. You can buy or sell at any point during market hours. Many ETFs track an entire index or a specific sector like technology or healthcare. An index fund is a type of mutual fund or ETF that simply tracks a market index, like the S&P 500. Instead of trying to beat the market, it aims to match it. Lower costs, long-term simplicity. And here's a fact worth remembering. Warren Buffett, arguably the greatest investor alive, has publicly said that for most people, a simple, low-cost index fund is the single best investment they can make. That's not laziness, that's wisdom, that's wealth clarity. A hedge fund is more advanced, using complex strategies like short selling or leverage to chase high returns, generally reserved for wealthy or institutional investors because of higher risk and capital requirements. Beyond funds, there are other important asset classes. Bonds are essentially loans you give to a company or government. In return, they pay you interest at a fixed rate over a set period, then return your original investment, called the principal, when the bond matures. Commodities include physical assets like gold, oil, or agricultural products, accessible directly or through funds. Currencies let you invest in money from different countries, dollars, euros, yen. And cryptocurrencies like Bitcoin or Ethereum are digital assets that operate independently of traditional financial markets. 2 tax-advantaged accounts every beginner should know. A Roth IRA lets your investments grow completely tax-free. You invest money you've already paid tax on, and in retirement, your withdrawals, including all the growth, are generally tax-free. A 401k is an employer-sponsored retirement account, often with matching contributions, which is essentially free money towards your future. Now you know what to invest in, but the market has moods, and knowing how to read them could be the difference between making a smart decision and panicking at the wrong time. That's next.
If you've made it this far, you're already ahead of most people who call themselves investors. Keep going. This next section is where it really gets interesting. Volatility measures how much prices move up and down. Highly volatile stocks swing dramatically in short periods. Low volatility stocks are calmer and more predictable. Volatility measures how much prices move up and down. Highly volatile stocks swing dramatically in short periods. Low volatility stocks are calmer and more predictable. Investors track the VIX, often called the Fear Index, which measures expected volatility in the S&P 500 over the next 30 days. When the VIX spikes, it signals that traders are bracing for big market swings ahead. A bull market is when prices rise over a sustained period. Confidence is high, optimism is in the air, and investors feel good. A bear market is the opposite. Prices falling, pessimism spreading, uncertainty dominating. A correction is a temporary pullback, typically a drop of around 10% from recent highs, without reversing the overall trend. Corrections are normal and healthy. When prices rebound sharply after a dip, that's called a rally. A crash is the extreme version, a sudden, severe drop often triggered by panic or a major economic event. A market bubble forms when prices climb far above actual value, driven by speculation and hype. Eventually, bubbles burst, and prices can fall just as dramatically as they rose. Finally, market sentiment describes the collective mood of investors at any given time. Optimistic, fearful, uncertain. Sentiment can move markets just as powerfully as company fundamentals, sometimes even more. Now that you understand market conditions, coming up, the investing strategies that actually work long-term, and one that even the most experienced investors consistently fail at.
There are 2 main camps when it comes to investing, and knowing the difference will help you find what works for you. Passive investing means buying a broad market fund and holding it long-term without trying to pick individual winners. Simple, low cost, and historically reliable for building wealth. Dollar cost averaging, or DCA, is a powerful passive strategy. You invest a fixed amount on a regular schedule, like every month, regardless of whether the market is up or down. It smooths out volatility over time and removes emotion from the equation. Here's a real-life example. Imagine 2 friends. One invests $500 every single month, no matter what, in good months and bad. The other waits for the perfect moment to jump in.
10 years later, the consistent investor almost always comes out ahead. That's dollar-cost averaging in real life. Lump sum investing is the opposite, putting a larger amount into the market all at once. It can grow faster if markets rise, but carries more risk if prices fall right after you invest. Active investing means picking individual stocks or timing the market to try to outperform the averages. It requires more time, more research, and more discipline. Buy the dip means purchasing a stock after it drops in price, betting on a recovery. Buy and hold means finding quality companies and holding them for years, letting compounding do the work. Market timing is the attempt to predict the perfect moments to enter or exit the market. Even professionals consistently struggle with this strategy. Speculation involves taking high-risk positions in hopes of significant gains, very different from long-term investing. Fundamental analysis studies a company's financials, management, and competitive position. Technical analysis reads price charts and patterns to predict future price movements. And macro analysis examines the broader economy, interest rates, inflation, global trends to inform investment decisions. Coming up, companies take actions that can affect your investment overnight. These are things every investor should know before they happen.
Companies aren't static. They take actions that directly affect your investment, sometimes overnight. An IPO, initial public offering, is when a private company sells shares to the public for the very first time. It's the moment everyday investors get access to ownership. After going public, a company might do a secondary offering, issuing additional shares to raise more capital. A buyback or share repurchase is when a company buys its own stock from the open market. With fewer shares in circulation, the value of remaining shares can increase. A stock split increases the number of shares by dividing existing ones. In a 2-for-1 split, every share you own becomes 2, and the price per share is cut in half. Total value stays the same, but shares become more accessible to everyday investors. A reverse stock split does the opposite, combining shares to push the price per share higher, often to meet exchange listing requirements. An acquisition is when one company purchases another, an event that can significantly move stock prices for both companies involved. For dividend investors, key dates matter. The ex-dividend date is the cutoff to qualify for the next dividend payment. Miss it, and you'll need to wait for the following round. The payment date is when the dividend actually arrives in your account. And finally, insiders. These are people with access to non-public company information, like executives and board members. Their trades are closely monitored and regulated to prevent unfair market advantages. One last section to go, and it's the one that ties everything together. These final concepts are what separate a confident, prepared investor from one who is just guessing. Let's close with the concepts that bring everything together and that every investor needs to understand. Diversification is one of the most powerful principles in investing. It means spreading your money across different stocks, sectors, and asset types so that one bad investment doesn't sink your entire portfolio. That's wealth clarity. Asset allocation takes it further, dividing your money between different asset classes like stocks, bonds, and cash, based on your goals, time horizon, and risk tolerance. Over time, some investments grow faster than others and throw your balance off target. Rebalancing is the process of adjusting your holdings to return to your intended allocation. Investors measure portfolio performance using metrics like alpha and beta. Alpha measures how much your portfolio outperforms or underperforms the market. Beta measures how sensitive your portfolio is to overall market movements. Think of beta like a sensitivity dial. 0 means the stock barely reacts to market moves. 2 means it swings twice as hard as the market. In plain English, if you hate losing sleep over your portfolio, you want a low beta. The Sharpe ratio shows how much return you're earning for the risk you're taking. A higher Sharpe ratio means better risk-adjusted performance. In plain English, it tells you whether the risk you're taking is actually worth it. Correlation tells you how closely two investments move together. If two stocks always go up and down together, It's like holding two umbrellas in one hand. You're not any more protected. In plain English, if everything in your portfolio moves together, you're not as diversified as you think. There are two categories of risk every investor should understand. Systematic risk affects the entire market, recessions, interest rate changes, global crises. Unsystematic risk is specific to a single company or sector and can be reduced through diversification. And finally, the economic backdrop that affects everything. Inflation is the rise in prices over time. Your money buys less than it used to. Deflation is the opposite, falling prices, which can slow economic growth. Stagflation is the rare, painful combination of rising prices, stagnant growth, and high unemployment. A recession occurs when the economy contracts over several consecutive months. Think of it like the economy catching a cold. Everything slows down until it recovers. Typically marked by falling GDP, rising unemployment, and declining corporate earnings. Monetary policy is managed by central banks like the Federal Reserve, using tools like interest rate changes and money supply control to influence growth and inflation. Fiscal policy is the government's lever, spending and taxes used to either stimulate or cool down the economy. And there you have it. Every stock market term you'll ever need, explained simply, clearly, in plain English. Here's what I want you to sit with for a moment. You just covered more financial vocabulary in one video than most people absorb in years of casual investing. The next time you read a market headline, check your portfolio, or open your brokerage app, these terms will feel familiar. Not foreign, not intimidating. Familiar. That's the whole purpose of Wealth Clarity Lab, turning financial complexity into total clarity. That's wealth clarity. If this video helped you, please give it a like. It genuinely helps more beginners find this content. Subscribe so you don't miss what's coming next. And if there's a term I didn't cover or a topic you'd love me to break down in its own video, drop it in the comments. I read every single one. I'll see you in the next one.